very much.
Of course, during the financial crisis, derivatives, hedge funds, and any exotic investments received quite a lot of negative coverage within the media. And it seems that the hedge fund industry has, of course, received most of the limelight. Derivatives, not so much. But just let's take a look at the current legislation and what Regulation 28 actually means for the pension fund industry. Are we going to see more pension funds getting involved within derivatives? Is it going to create more clarity?
Well, I certainly hope so. The situation is that new Regulation 28 was put forward during February. Compliance to that piece of legislation is required by the end of this year, 31st of December. That piece of legislation explicitly references another document by the FSB called the Conditions for the Use and Disclosure of Derivatives. Now, that was released in a draft form earlier this year at the end of July. And then, as I mentioned, compliance is obviously required by the end of December to the main regulation, which references this.
Well, let's look at the current legislation as it stands right now. Is it going to affect the industry significantly, or is it going to allow for more clarity so that there isn't a fear to invest in derivatives?
I think definitely. I think previously under the old Regulation 28, derivatives were never explicitly mentioned. That's really because the legislation predated their usage. I think that this will certainly encourage their usage. Probably one of the biggest moves forward in terms of the new legislation is the treatment or recognition of derivatives. There's always been questions around, does one treat them as an other asset, which was referenced in the old legislation, or on an effective basis? The new regulation introduces a concept known as the look-through principle, which aims to see what effective exposure or end exposure does one achieve through various investment vehicles.
Dwayne, would you say that it does fall under the risky investment asset classes? We know, as I mentioned, hedge funds have also been viewed quite risky, but interestingly enough, pension funds are now allowed to invest from around 5% in private equity and hedge funds to around 15%. So we've actually increased the allocation here in South Africa at a time where we see regulation being relatively rife on a global level. So a different movement that we're seeing in South Africa.
I think a very mature stance taken by the regulator in terms of introducing the riskier asset classes, as you refer to the hedge funds and the private equity. They are capped at 15% collectively between the two. However, in their comments to the release of Regulation 28, the regulator pointed out that they recognize that one can be overly conservative as well, that strategies such as a pure cash allocation within a pension fund could be as damaging as taking on high levels of risk. So they've put on a certain amount of limitation in terms of what one can do with hedge funds. For example, one of the conditions is that you may only invest in a hedge fund if you cannot lose more than 100% of your investment. So essentially no geared losses beyond what you invest.
Tell us a little bit more about derivatives with regards to the significance within a portfolio. Is it about cost reduction at the end of the day? Is it about capital protection? But that seems to come at a high cost, and it's all about the risk that you take on.
I think the efficiencies that can be achieved through derivative use are enormous. Last year it was a $670 trillion market relative to global wealth of around $200 trillion. In terms of trading costs, it can reduce trading costs enormously. A recent study by Peregrine Securities demonstrated that if trading the index, you're looking at probably around a 49 basis point double to go in and out. Trading in physicals, around a 1 basis point in and out if you're using index futures. So the cost saving potential is enormous. Also, just from a liquidity perspective, there's large opportunities, and a risk control perspective. Unique opportunities available in the derivatives market in terms of addressing very specific inflation or interest rate risks that are faced by pension funds.
With regards to the regulation, how is that going to affect the derivative market? I know within the hedge fund industry we kept talking about that hedge funds could land up looking like unit trusts. Is there a risk that the regulatory environment could actually hamper the possible returns within the industry?
I don't think so. I think it's probably going to encourage longer-term appropriate usage. One of the interesting points that the FSB has made, they've taken a very clear stance that derivatives are not an asset class but just a means of accessing asset classes. So again, that look-through principle. On that sort of clarity that they've provided, I think on that basis I'm hoping the trustees will feel more comfortable engaging with these instruments, and that also the legislation, the explicit legislation, will really just draw attention or gain impetus for this market.
Of course, you were talking about the conditions that are going to be attached for pension funds. Give us an indication of what we're looking at right now, and what kind of allocation will we actually see down the line. I know that you were talking about December deadline.
I think probably one of the biggest implications that trustees will see in terms of the day-to-day management of funds is far larger amounts of reporting being done. There's quite a lot of explicit reporting that is required. on effective exposures measured through delta, for example, physical exposures. A lot of these are probably fairly complex issues for most trustees to deal with, so I think probably the shorter term impact will be a lot of trustee education and assisting trustees in dealing with these.
Would you say that we're going to see consolidation within the industry?
I think that it's a possibility, and I think that it's something the FSB has been quite open about. They've mentioned the consolidation from 13,000 to 3,500 funds. They've also mentioned explicitly in their comments to Regulation 28, they made a comment around that they see a lack of general expertise in investments within trustee boards. So I think they're quite open to that sort of condition, and I think they're also quite open to the idea of consolidation, which would sort of concentrate the management skills that we do have available to us. And I just want to make an additional comment. I think that if consolidation does occur, it need not occur through perhaps, say, umbrella funds or platforms, etc. There are other ways to achieve this. For example, industry funds that we've seen being used quite effectively of late.
Take us in terms of what we could see into next year. We know that a lot of people, the hedge fund industry and actually within the market where we see derivatives being offered, there's been a very big reluctance to allow for regulation. Do you think that, I'm sure you have been speaking quite closely with a lot of the fund managers out there, are they open to regulation? Do they think that it is a positive, given the fact that we weren't hard hit in 2008 and the self-regulatory model that we've embarked on in South Africa has actually worked to the benefit of the hedge fund managers and managers as a whole? Certainly,
I think I've dealt with quite a few asset managers and hedge fund managers on this, and I think everyone's quite pro the derivatives guidance, just in terms of the clarity it provides, and I think the protection it adds for the end user, which is really a member saving or their life savings that they're contributing towards their retirement. I think there will be an implication for certain asset managers. There are quite tight conditions for the usage of derivatives. So, for example, we are shorting derivatives. There are conditions around how much mismatch you may have in terms of that derivative and the underlying. So I think some asset managers will need to adapt slightly their approach.
So in other words, we can actually expect lower returns. Is that what you're saying?
I don't think so. I think derivatives don't imply a specific kind of return. So, for example, if you are interested in getting equity exposure, you can do that through derivatives or the physical market. I don't think it's going to have a massive implication on what the asset managers are doing. Hopefully it costs members less in the long term because of the efficiencies that can be achieved through using derivatives.
What kind of cost reduction are you expecting, Dwayne?
I mentioned earlier that that's a really 50-fold reduction in cost in terms of a round trip, which is very, very large. That is a very specific case, though. That is if you are trading in and out of a portfolio which very closely resembles the index. So there are situations where it will be very, very useful in terms of reducing cost, and there are situations where it won't be as applicable.